Okay, welcome everybody to the travel events in Milan. So, unfortunately, she did not attend her travel events via Skype, but we were able to organize everything, so we did in France. So, the floor is yours, Nina. You can start your presentation and see what you do for the users.
My name is Nina. I started my PhD 6 years ago in 2011. I spent 4 years at the University of Gallen. Then I spent 1 year and a half at Bordeaux School, University of Pennsylvania. Then I was on the job market, and later this year I'm going to join the PhD business at the Ohio State University. I was a physical professor there. And the thing is that it's hard to get the visa right now. So the reason I'm presenting online is that I'm not advised to leave the US since this might worsen my visa process. Okay, so I really would wish I'm able to be there with you right now, but unfortunately it's not possible. And I'm very thankful for giving me the opportunity to present online. Right now, I'm temporarily visiting for 2 months University of Chicago, and for me, it's a little bit special to defend my thesis from here, since it was my dream since 4 years to visit this place for a little bit. So I feel a little bit special about that. But on the other hand, I wish I was able to be there. Okay. 6 years, 3 papers, okay? So the first paper I wrote together with Angelo Ronaldo and Paul Zoderlin. We spent about 3 years on this paper, and I think I learned a lot. I'm very thankful for the chance to work on this, and I think that maybe without this experience, I wouldn't be able to progress later in my. So then I wrote 2 single author papers, okay, number 2 and number 3. Right now you can see the screen well. You don't need to see me well, okay? You see the screen well. So currency strategies and sovereign ratings. It was my first attempt to write something by myself. The dollar ahead of FOMC target rate changes. It's my second attempt to write something by myself. And this paper has been my job market paper. So the paper which I presented, I think in total around 15 times at different places. And I'm gonna spend maybe a little bit more time on this paper since it was so important for me over the last year and a half. Okay. Understanding currency liquidity. So we have been trying for 3 years to understand currency liquidity. And in order to, in the pursuit of understanding currency liquidity, we first had to find out how to measure it. And apparently no one before us have measured currency liquidity over the long time period and for many currencies. So we have tried to do that. How did we do that? We had some fancy high-frequency data, and we had some less fancy data, low-frequency data, like daily data, which is readily available. And we figured out that you actually don't need that fancy data that much. You can just use less fancy, low-frequency data and proxy currency liquidity pretty well. So you see 2 measures, one based on the blue is based on the less fancy data, the red is based on the fancy, expensive data, and the 2 track each other pretty well. So first we found out this, and then we thought, okay, this is only from 2007 to 2012, but how did currency liquidity look before that? Before 2007. So we used our, this less fancy daily data, low frequency measures, to go back into the past and to start in 1991 when I was just 2 years old. Okay, so we plot here currency liquidity from 1991 to 2013. This is the aggregate liquidity on the currency market. I love this chart. I hope you enjoy looking at it as well. This is our main chart of our paper. Here you can see liquidity jumps up, jumps down. And what do you think, when does currency liquidity goes down the most? 2008, financial crisis. Liquidity tends to go down during the financial crisis. And a small break, Nick, I think, has joined us. Nick, do you hear me well? Do you see me well? Hi, Nick. Welcome to the PhD defense. It's very nice that you are here and that you have made it to log in. Okay. I have already started 5 minutes ago, so I just continue. I have 30 minutes in total, and I think 5 minutes are already there. Okay. Let me continue. So, our beautiful picture of currency liquidity from 1991 to 2012. Liquidity tends to go down in bad times. The largest drop has been in financial crisis, but also at other times like the kilo peso crisis or Russian crisis, currency liquidity went down. And then we thought to understand do you have a question, Paul? No, okay. Like that, okay. Then we tried to we were trying to understand what drives currency liquidity. What are the factors driving currency liquidity? So we looked at a bunch of financial variables from currency market, bond market, and stock market, like risk and return measures on those markets, and we tried to figure out which of those measures are correlated with currency liquidity. And we found out that currency liquidity is correlated with bond and stock market liquidity, as well as with the risk measures in the bond and stock market. What else did we do? We also looked at the movements between different liquidities for different currency pairs. We found out that euro-dollar liquidity moves with the Swiss franc dollar liquidity, and with the Australian dollar US dollar liquidity, and also with euro British pound liquidity. And we also figured out what kind of factors explain these movements between various currency liquidities. Okay, that were 3 years in 5 minutes. I mean, in a nutshell. Okay, it was, as I said, I learned a lot while working on this, and after that, I thought, okay, let me try to write a paper by myself. I need to have my own single author paper. So my attempt was to write the paper on currency strategies and sovereign ratings. Okay. So this is my first attempt to do something by myself. I think I found some kind of acute fact, but then I a little bit struggled to move it forward and find good stories behind that. So basically, there are three most popular strategies for currencies. It's carry trade, number 1, momentum, number 2, and value, number 3. So both of them yield, all of them, actually 3 of them, don't look at this line right now. All 3 of them yield highly significant returns when you consider all currencies, okay? So then I thought, what if we look at various currencies what if we sort currencies by level of country ratings? Fitch, Moody's, S&P, they provide sovereign ratings for a country, and I thought, okay, what if we look at the better rated countries and worse rated countries, and look how currency strategies look like within better rated currencies and lower rated currencies. It would be like Swiss franc, Switzerland is very highly rated, Australian dollar apparently too. So I looked at the current of the performance of currency strategies within better rated countries and within worse rated countries. So I found that carry trade and momentum still earn high profits if you consider only best rated currencies. However, this doesn't work for currency momentum. Currency momentum appears flat when you only use developed or highly rated countries in your sample. So if you only trade like Swiss franc, Australian dollar, British pound, and other AAA currencies, and you think that what happened, the past return is going to predict future return, this doesn't happen. So winners do not outperform losers. We've seen a bundle of well-rated countries. That was my main finding of my single author paper. So I was thinking, what does it imply? And the best story which I can say you about this finding is that momentum maybe works for, so you need basically, for momentum to work, you need to include emerging or low-rated countries in your sample. And maybe momentum works for those countries because actually it's maybe hard to trade them. It's hard to rebalance portfolio, it's costly. And okay, you know that the past month's return would predict future month's return, but it's for you very costly to rebalance and you just, or maybe very risky, and therefore momentum still stays there. However, for better rated countries, everyone knows that Bitcoin momentum is gonna work, and we don't see momentum. But still, I'm still struggling with this argument. Your ideas about that, I'm happy to hear them. Another thing which I looked at this paper, I looked at the sovereign rating changes. Do sovereign rating changes impact currency strategies? And the answer is no. So basically, if you think that currency strategies deliver their profits from the times when countries experience a sovereign rating downgrade, it's not true. You can remove the periods of sovereign rating downgrades and upgrades from your sample, and the performance of currency strategies remains the same. Another huge fact in this paper, which I think I found, is that higher credit risk currencies or currencies with lower rating, like CCC, BB or something, they tend to depreciate, go down during 6 months before the sovereign rating downgrade. Okay, the depreciation of those currencies before. I mean, it kind of means that sovereign ratings downgrade when things have been already too bad. But if you think about implications for a currency investor, the thing is that you don't know in advance when this downgrade is going to happen. So if you observe the downgrade, you cannot actually trade on this because currency is already depreciated. You observe downgrade here, and you are not able to exploit this. Okay, 15 minutes. And I'm done with 2 papers, and now I have 15 minutes for my job market paper and for my closing words. Okay. So this paper, I mean, it was a good start for me in terms of learning to work by myself. But when I came to Wharton, thanks to Nick for that, I realized that I need something. Something cooler. I mean, you need a job market paper to graduate if you want to work as a professor. And I presented it once at Wharton when I came, and that was one more time when I realized that maybe it's not that cool in the sense that I probably won't be able to be very successful or very happy on the job market with this outcome. So I was thinking hard about another idea. Yeah, I was trying to come up with some other idea, and I will tell you now about it. It turned out to be my job market paper, which I developed while visiting Wharton. Okay. Are you ready? Okay, the title of the paper is "The Dollar Ahead of FOMC Target Rate Changes." FOMC, Federal Open Market Committee. So this is the committee consisting of 12 people. They basically are the part of the Federal Reserve System, Central Bank of the United States. So there are 8 meetings, FOMC meetings per year. No, right now the head of FOMC is Janet Yellen. So basically, the task is to decide what would be the main interest rate in the country for the nearest time, for the nearest future months or 2. Okay, so they meet 8 times per year. So what I found, again, currencies. You know, I love currencies. So I looked at the dollar. The basket of dollar versus a basket of currencies around those meetings, around each of those meetings. And you know, in the meetings, there are 3 things they can do. They can leave interest rate the same, or they can increase it, or they can cut the interest rate. You know, interest rate increase is like monetary policy tightening. Interest rate cut is monetary policy expansion. So what I found that the dollar appreciates, you know, rises during the 2 days. During the 2 days before the Fed decides to increase the interest rate. And the dollar depreciates versus other currencies during the 2 days before the Fed decides to do an interest rate cut. So that was my first observation. I was like, that's cool, but what does it mean, and what can we make out of it? So then I figured out there is a federal funds futures market. The federal funds futures market is just a financial market which tries to, which reflects market participants' expectations, what the Fed, you know, FOMC will likely do at the forthcoming meeting. Will the Fed increase the interest rate, do the interest rate cut, or nothing? So basically, you can look at this fixed income instrument, the federal funds futures, and you can figure out from looking at those futures what the Fed will most likely do. I mean, what market expects the Fed will most likely do. And it turns out that these Fed fund futures are doing extremely well in predicting what the Fed will do. They do it with 90% accuracy over the last 20 years. So basically, you don't even have to know what the Fed will do, but you can look at the Fed fund futures. And if they say with more than 50% probability that the Fed will likely increase the interest rate, then there is a trick for you to do. Go long the dollar for 2 days before this announcement. Okay, so if the announcement of FOMC meeting is scheduled for Wednesday, for instance, very often they're scheduled on Wednesday at 2 p.m. On Friday night, you can just look at the federal funds futures, and you can see what they imply the Fed will most likely do. Do an interest rate increase or interest rate cut? If the Fed fund futures say that market participants expect an interest rate increase, buy the dollar, sell other currencies, okay? And short the dollar and buy other currencies if the Fed fund futures say that the Fed will likely decrease the interest rate. And you can build a profitable strategy from that. So in June, the Fed is likely again increase the interest rate. So if you believe me right now, then prepare your savings and you can trade on this maybe. But be careful. If you earn money, I'm happy. If not, I'm sorry. Okay. Now, if you like analogies, so another way to explain my main result is an analogy with thunderstorm. Okay. So if there is a thunderstorm, what do we see first? We first see lightning. Okay. And then we see the thunder. Not see, but hear the thunder. Okay. And then there starts a heavy rain. So analogy in my market paper is like Fed fund futures is like lightning. You're like the Fed is likely to increase the interest rate. So Fed fund futures is like a signal that you know there will be storm. Most probably the Fed will likely increase the interest rate. And if you see the Fed fund futures indicate that the Fed will likely increase the interest rate, so what will happen? Most likely the thunder will be. Oh, it means that the dollar would appreciate prior to such FOMC announcement. I hope you like my analogy. It's Nick helped me to come up with it. Thank you, Nick. Okay. Some cool charts. Okay, I really like cute graphs. So this is the main graph of my job market paper. I spent many hours to construct this chart. Okay, now you will see, and yeah, I think first half a year this graph was with wrong standard error, so it took me several months to figure out how to do them correctly. But I think now I'm pretty sure they are okay. So what do you see here? Here you see the average cumulative dollar returns around interest rate cuts. So it's the red line. Cumulative dollar returns around interest rate cuts are in red, and cumulative dollar returns around interest rate increases are in green. And here, warning, I use ex-post data, meaning that here I don't use any federal funds futures. This is using the ex-post data in terms of that we already know what the Fed has actually done. We are like the God. We know that the Fed has already increased the interest rate, and we just plot what happens on average around such announcements. So what do we see? We see that the dollar, on average, around 23 interest rate cuts. The dollar on average goes down, depreciates versus a basket of currencies. And this line going down means the dollar depreciates. I mean, this works pretty well for the dollar-euro. So you can think of it that the dollar depreciates versus the euro, meaning that euro appreciates. And what happens prior to the interest rate raises? Prior to the interest rate raises, the dollar appreciates, goes up, and euro goes down. And the effect is about 20 basis points. So the dollar goes down about 20 basis points on average and goes up about 20 basis points prior to the raise. Okay, so here I didn't control for the actual market expectations as indicated by the federal funds futures. And now suppose that here, on Friday, because this is Wednesday, day of announcement, this is day before today, and here on Friday, suppose we were to look at the federal funds futures and would try to figure out what federal funds futures say the Fed will most likely do, or what the Fed fund futures indicate, what market expects the Fed will likely do. It's very easy to figure out. It's like, it's all like percentage probabilities. You can find it online. The data is very public and very available and very easy to calculate. So it sounds fancy, but it's very easy actually. So here you look at the federal funds futures, and then we would look how dollar looks like after that. So right now, I will not use any ex-post data. And I will show you the same chart, but without using any ex-post data. So here is this chart, and it looks almost the same. The difference is very tiny. And the difference is very tiny because Fed fund futures are so good in forecasting what the Fed will actually do. They do only 6 mistakes over the last 20 years. This covers 1994 to 2015. So Fed fund futures do only 6 mistakes out of 160 something meetings, okay? 5 out of 164, about that. 8 meetings per year, 1994 to 2015. So Fed fund futures were extremely well in predicting what the Fed will do. So it turns out that actually you don't need to know here what the Fed will do here. If Fed fund futures say the Fed will increase the interest rate, you go long the dollar and you earn 20 basis points on average. Or you short the dollar if Fed fund futures say that the Fed will do in the interest rate cut. Okay, and now I plot these returns, these 2-day returns, starting from 1994. So, if 1994 was 5 years old, and if I, 5-year-old girl will come to you and say oh, I know this strategy, for the next 20 years, if the Fed fund futures say that the Fed will likely increase the interest rate, then go long the dollar. If Fed fund futures say the Fed will likely cut the interest rate, then go short the dollar. And if you were to listen to this kid, 5-year-old kid, then this would be your profits from going long the dollar prior to the interest rate increases by the Fed for these 2 days. These are 2-day returns. You don't earn each time, but you have to be patient and wait. Here in the start of the sample, you would lose like a bunch of times, and you would think, I shouldn't have trusted this girl, okay? But then later on average, you would earn on average like 20 basis points. And here is the dollar prior to the cut. So here you short the dollar. So this is negative. Dollar depreciates, but since you short the dollar, this would be actually your positive profit. So also, if you turn this around, okay, maybe you would be unhappy around 2001, but you would be very happy in financial crisis when everything goes down. My strategy, you short the dollar, so you would do pretty well. And here are the cumulative profits from this strategy. You just accumulate these returns together with these returns. Here is the cumulative returns for that strategy. If I adjust for transaction costs, everything remains the same. The mean strategy returns 25 basis points, and annualized Sharpe ratio, annualized one, so it's not straightforward relationship, is 0.93, which is pretty well. It's slightly higher as compared to the other strategies. But certainly, my strategy implies only trading very infrequently. You would have traded only times over 20 years, 54 times, no, 57 times. 57 times for 2 days. So in total, you hold the position 114 days out of 20 years. So you trade infrequently to do this. So the summary of my job market paper. I mean, you think, okay, what does it mean? What does my finding mean? Okay, the Fed fund futures seem to forecast where the dollar will go. But what does it mean? So it took me half a year to figure out how to interpret my finding. And the interpretation is that it means that Fed fund futures are smarter or know more about the forthcoming FOMC decision than the currency markets. So Fed fund futures are faster in incorporating information about forthcoming monetary policy change to the dollar. And therefore, you're able to use Fed fund futures to forecast where the dollar will go prior to the FOMC announcement. This is very surprising, isn't it? Because currency markets are the most liquid markets in the world, and you would expect that they are incorporate information faster than other markets. But my results indicate that in those time windows prior to the FOMC announcement, the Fed fund futures seem to be faster in incorporating information about forthcoming monetary policy change than the currency markets. I was trying to figure out why, what are the, I mean, this like delayed or slow information diffusion across markets is my story, but this story is hard to square with the existing pricing theories. So I was trying to explain it with a standard series, but I don't have any consistent explanation for that. Check out my website, www.ninakarnaukh.com, for this paper and for different robustness checks which I am doing and different tests and explanations I'm trying to find. But my conclusion is that this is kind of a puzzle, that the dollar goes up prior to the FOMC announcement. So in the very nearest or nearest future, while working on this my job market paper, I got interested in general how different asset markets, currency, stocks, and bonds incorporate information. I'm also interested in figuring out the effect of monetary policy on asset prices. I believe that monetary policy affects asset prices not only at the scheduled or unscheduled central bank meetings, but also during these times when they do speeches, so in between the meetings, and figuring out how fast do asset prices respond to this revelation of information through speeches is something that I'm interested in. It affects not only near-term expectations, but also longer-term expectations, you know, like 5-10-year yields, and figuring out how fast currencies and maybe other markets incorporate this information would be very interesting. Mysterious exchange rates. Okay, so I believe that we don't know much enough about currencies and understanding what drives them, and maybe being puzzled about what drives them would be something very interesting to figure out. And now, in my last 2 minutes, I'm gonna mention. I was thinking, okay. So over my PhD, I was talking with my best friend Tanya, who is now watching us online, and I was sharing with her what I learned. I mean, not in terms of equations and stuff, but just in general, like some human qualities and some other things which I've realized. And she was telling me each time, Nina, you should write this down, because I mentioned to her that I probably plan to mention it during my PhD defense. And Tanya, I'm sorry, I didn't write it down. And so last week I was trying to remember all of that. I mean, I was able, but I'm sure that if I were writing down all of this, that would have been much easier. But right now, I feel that many of those qualities that I've learned are almost like a part of me, maybe in some sense, and maybe that's why it's hard for me to judge that this is something new. But there are three things which I have learned over my PhD, and I think they're very important, and I would like to mention them, or 3 things which I realized. So the first thing, number 1, is respect. So respect other people, respect others' work, no matter how good it is or how bad it is. Respect efforts. It's not easy to achieve something, especially in the start, and it's easy to judge someone on when his progress is slow. But you realize after you fail many times, you realize that it's not easy. Everyone is allowed to fail, and we should give chances to people to fail and respect it, and don't laugh from them, and because this will happen to us, and then we will struggle, if we see that. Maybe it sounds funny for you, but for me it was something like a big lesson, and I'm still working on that. I'm still working on realizing how important it is to respect others' work, no matter how good or bad it is. Then other thing is truth. So I think that the most important thing in doing research is figuring out the truth, or trying to figure out the truth. And this should be above any other pursuits, like above pursuing more publications or having big ego and showing off in front of people. Truth would also allow you to be open to the feedback, and if someone says that you are wrong, that you don't want to prove that you are right, but you want to figure out the truth. So I think that if everyone not in the world, at least in research, when doing research, they were focusing on finding out the truth and not pursuing other goals, that would be really very nice. And number three is love. So what do I mean by that? I mean that I think doing research is like sharing your love to the world, to the other people. Because in the end, the purpose of doing research is understanding better the world, and hope that this will help current and future generations live better or understand things better. And in some way, I think it's care and love. And I would like to thank my main advisors who helped me to grow, and to learn how to share love in the future with the world. Without Paul, I wouldn't be able to start my PhD at all, because Paul was the one who believed that this unknown girl from Ukraine and gave her a chance to come to Gallen. Okay. Without Nick, I wouldn't have been able to come to the US to Wharton and to experience different level of academia, different kind of finance. Thank you very much, Nick. And one more person who has been my inspiration over the last 4 years, John Cochran. I've learned a lot from him, and maybe if one day he watches this online, just one message for you, John. I'm trying to find all the elephants in the room. Okay, thank you everyone for listening to me. I highly appreciate your time and effort, and I will be eternally grateful for my main advisors for helping me to go through these 6 years. Thank you.
Do you have one more? No. Oh, Nick, do you have some question for Nina?
Nick, can you speak louder?
Can you hear me?
Yeah. Now I can hear you.
Okay, I think I'm good. I don't think I have any questions at this point. Do you guys have questions?
No. Thanks for the presentation. I don't have any questions.
No. Somebody else? No, thanks for the presentation. And we take a couple of minutes to decide. Okay, and then we are back.
So, yes.
2 minutes.
Okay, 2 minutes. Guys, it's going on for a long time. Now it's time for you to get yourself. So, how many people are in the audience?
6.
6. Thank you for coming. I wish I was there, but I know. I hope you weren't bored or spend too much time on iPhone. I hope so. I don't see everyone. Maybe you can say me your names shortly. I know Katja. Katja is on the left. Who is sitting on the right?
Students, at least I'm a master student here at the university, and he's a PhD student. We wanted to see how like the defense works.
What are your names?
Okay, we're back. Oh. So, congratulations, Nina. This is the final step for your PhD.
Thank you.
Congratulations.
Defense, no problem. What I want to share with you, I don't know if you know it already, but you also won the prize. You won the prize for the best thesis in the PEF this year. Can you read it?
No, I cannot. But Oh my God! Thank you so much. Oh, I remember.
So we had a number of exceptional theses this year. So we had 6, and for this year we decided to split the prize. You won it together with Helge Liebert. We got one part for finance and one part for econometrics, and you were what we thought the most successful candidate for this year. So congratulations also for this achievement. This is a copy, and you will get the form, the true official form at the ceremony.
Thank you very much.
Okay, Nina, congrats. Now I have a word from Nick. Can you hear me, Nick?
Yes, I can, yes.
First of all, thanks a lot for helping out in this process.
Of course, it was my pleasure. It's great.
Second thing, believe it or not, we also have to grade this presentation. I'll send you the form to scan in the form and send it so you can sign it, okay?
Okay.
Good, you return it by email. Okay, thanks a lot.
Okay, will do.
And thanks also to the name of the program committee to be part of this conference. Good? No, it's enough. See you. Bye. See you. Bye.
See you all.
Bye, thank you.
Bye, thank you.